Hey everyone, welcome back to Corporate Dakota, the place where we tried to make sense of the crazy world of corporate finance. And boy do we have a treat today because Applife Digital Solutions Inc. has been busy cooking up some deals that might just surprise you, and maybe not in a good way if you are a shareholder paying close attention. Before we dive in, if you like cracking open these dusty corporate filings to find the real story, smash that subscribe button. Also, join our Discord community linked in the description below to chat with fellow corporate detectives. So, Applife Digital Solutions Inc. has put out a Form 8K, which is basically a filing to report any big stuff happening that shareholders need to know about pronto. Think major events like mergers, bankruptcies, or, in this case, a whole lot of financing. Let's cut to the chase because Applife has been raising money, and not in the way that makes you think they're suddenly printing cash. It looks like they've been leaning heavily on convertible promissory notes. Now, what is a convertible promissory note? Well, think of it like a loan that can be turned into company stock later. It is a common way for companies, especially smaller ones, to get funding without immediately diluting existing shareholders too much. On the 19th of November, they issued a couple of these notes. Each was for $60,000, but because of something called an original issue discount, they only actually got $54,000 for each. So right off the bat, they're paying an extra $6,000 for that note. The notes have a 12% annual interest charge, but here's the kicker: they earn that interest in full on the day the note is issued. So it is like paying interest upfront, and these notes last for 12 months. The really interesting part is how they can be converted into stock. The price is set at 65% of the lowest stock price in the 10 days before conversion. This means if the stock price drops, the investors can convert their notes into more shares, which could really hurt the price of existing shares if a lot of this happens. Plus, there is a limit on how much stock any single investor can own at 4.99%, which is a way to try and avoid triggering certain reporting rules. Then, just a day later, on the 20th of November, they issued another convertible note, this time for a bigger amount, $150,000. This one is due in August of 2026 and has a 5% interest rate. It also converts into common stock, but at a fixed price of 1 cent per share, which is pretty low and suggests they really anticipate the stock price to be very low or need a strong incentive for this investor. And just as this report was being filed on the 25th of November, they did another one of those $60,000 notes with the $6,000 discount. This pattern of issuing these notes, especially with a discount, suggests the company is hungry for cash and willing to pay a premium for it. But that is not all. There is a whole other deal here with something called CM. It looks like Applife entered into a purchase agreement with a CM selling stockholder. This agreement allows Applife to sell up to $15 million of its common stock to CM. Along with this, they signed a registration rights agreement. This basically means Applife has to file paperwork with the Securities and Exchange Commission, or SECSO, so that CM can legally sell the shares they might buy from Applife. And as part of this CM deal, Applife issued a note for $225,000. This is called a commitment fee, and it's about 1.5% of that total $15 million potential deal. So how does this CM deal work? Well, Applife can essentially decide to put or sell shares to CM up to that $15 million limit. There are a few ways they can do this. There is a fixed purchase option. Applife can tell CM to buy shares on any business day. The price is set at 95% of the lowest of two things. First, it's 95% of the average stock price over the 5 days before the purchase. Second, it's 95% of the lowest stock price on that specific purchase day. If the stock price actually closes lower than this calculated purchase price, then the price gets reduced to that closing price. They can only do $100,000 worth of these per Dalton Y. Then there is a VWAP purchase. This is similar, where Applife can make CM buy shares at 95% of the lower of the closing price that day, or the volume-weighted average price over a specific period. Again, there is that $100,000 daily limit. And there is an additional VWAP purchase, which seems to work in a very similar way, also capped at $100,000 a day. The key takeaway from all these purchase methods is that Applife can get cash from CM by selling its own stock, but at a discounted price of 95% of the market price, or even lower if the stock price falls. This is a way for them to raise money, but it really depends on the stock price doing well. If the stock price is low, they'll be selling a lot of shares for not much money. This is often called an equity line of credit or a lock. The company also has to follow certain rules and conditions laid out in the CM purchase agreement. This agreement has a few ways it can end or be terminated. It could naturally expire if the registration statement goes away or if CM buys the maximum amount allowed. But it also ends if the company's stock stops being listed on an exchange, or if the company goes bankrupt or can't manage its affairs. Applife can end the deal with 1 day's notice, but CM needs 10 days notice if certain bad things happen. These bad things include Applife failing to keep its registration statement effective, or its stock not being listed anymore. Let's quickly touch on that registration rights agreement again. Applife has to file a registration statement with the SEC for CM to sell the shares. They need to get this registration statement approved by the SEC within 60 days if it's reviewed, or 3 business days if it's not going to be reviewed. CM has agreed to wait for this, but the obligation remains on Applife. Remember that $225,000 commitment note? Yes, that is the commitment fee for the CM deal. And on the 20th of November, CM also bought a separate $150,000 convertible note in a private placement. So CM is really engaged here. All these notes we just talked about, they create financial obligations for Applife, meaning they owe money or have to issue stock. And these sales of convertible notes, they were not registered with the CC. This means they were sold under specific exemptions, usually for private placements to accredited investors. This is standard for companies like this raising funds, but it means these sales aren't subject to the same public scrutiny as a registered offering. Finally, the report lists all the exhibits, which are the actual legal documents for all these agreements and notes. So what does this all mean for Applife Digital Solutions Inc? The company is clearly in a growth phase, or at least trying to be, and needs cash to operate and expand. They're using convertible notes as a primary funding tool. The discounts and the conversion price being tied to a percentage of the lowest trading price mean that if the stock price falters, investors can convert their debt into a significant amount of equity, potentially at a very low cost basis for the investors. This can lead to substantial dilution for existing shareholders. The CM purchase agreement is interesting. It gives Applife flexibility to raise up to $15 million by selling stock, but at a discount. This is essentially an equity line of credit. It is a lifeline, but it comes at a price. If the company needs cash urgently, they can tap into this. But it will likely depress the stock price further due to the discounted issuance of shares. The daily limits and the VWAP pricing mechanisms are designed to manage this dilution to some extent, but it is still a concern for existing shareholders. The need for registration rights indicates that the shares issued under the CM agreement are intended to be freely tradable by CM in the public market, which will increase the available supply of the company's stock. The company appears to be juggling multiple financing arrangements simultaneously. This suggests a constant need for capital. The short-term nature of some of these notes and the upfront interest charges point to a company that might be facing immediate cash flow challenges. It is a strategy, but one that can become a treadmill if the core business doesn't generate enough revenue to eventually pay off these obligations without excessive dilution. My take on this filing is that Applife Digital Solutions Inc. is in a precarious financial position, relying heavily on debt that can convert into stock. While this allows them to get cash now, it puts existing shareholders at risk of significant dilution. The company needs to demonstrate a clear path to profitability and cash flow generation to justify these financing strategies and stabilize its stock price. The CM agreement, while providing a potential substantial funding source, also carries the immediate risk of impacting the stock value if and when those shares are sold. The company's direction is clear: growth financed by debt for equity instruments, but the sustainability of this model hinges entirely on future performance and market conditions. The main risk here is continued stock price decline, which exacerbates the dilution from these convertible instruments. Alright, that is our breakdown of Applife Digital Solutions Inc. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.